According to the IRS, up to 85% of your Social Security benefits can be included in taxable income. Not taxed at 85%, included in taxable income, and then taxed at your ordinary rate. That distinction matters because once your income crosses certain IRS thresholds, more of your benefit becomes exposed. And here's what most retirees don't realize. Those income thresholds, $25,000 for single filers and $32,000 for married couples filing jointly at the first level, have not been indexed to inflation since they were created, which means, over time, more retirees drift into taxable territory, not because they're wealthy, because the structure hasn't moved. You did what you were told. You saved in tax-deferred accounts. You delayed taxes. You built retirement income. And you've probably heard this phrase, you'll be in a lower tax bracket in retirement. That sounds reasonable until you look at how Social Security taxation actually works. The IRS uses something called Provisional Income. It's calculated as your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. If that number crosses certain thresholds, then up to 50% and eventually up to 85% of your Social Security benefit may be included in taxable income. Again, not taxed at 85%, included, then taxed at your regular rate. According to the Social Security Administration, about half of beneficiary households pay federal income tax on their benefits, and because those thresholds are fixed, more retirees cross them over time. That's the quiet drift. Let's make this concrete. Imagine a married couple receiving $40,000 per year in Social Security. They withdraw $35,000 annually from a traditional IRA. Half of their Social Security, $20,000, is added into provisional income. Now add the IRA withdrawal. They quickly exceed the $44,000 upper threshold for married couples. At that level, up to 85% of their Social Security may be included in taxable income. If 85% of $40,000 is included, that's $34,000 added to their taxable income calculation. Not $34,000 in tax, but $34,000 subject to their ordinary income rate. Even a few $1,000s per year in additional tax exposure over 20 to 25 years compounds. It's not unusual for that layering effect to redirect $75,000 to $125,000 over a full retirement, not because of a mistake, because of interaction. Now add required minimum distributions. Under IRS rules, beginning at age 73, traditional retirement accounts require annual withdrawals based on life expectancy tables. If someone has $900,000 at 73, the required withdrawal is roughly 3.8%. That's over $34,000, whether they need it or not. As account balances grow, required withdrawals grow, which increases provisional income, which may expose more Social Security to taxation. And under Medicare IRMA rules, higher income can also increase Part B and Part D premiums. So now you have three systems interacting: mandatory withdrawals, Social Security taxation thresholds that don't adjust, and income-based Medicare premiums. This isn't dramatic, it's structural. You'll hear people say, it evens out. That sounds comforting, until you project 20 years of forced withdrawals into fixed thresholds. Time doesn't smooth it. Time magnifies it. Vanguard research consistently reminds investors that tax deferral is not tax elimination. Fidelity's retirement income analysis has shown that large late-life withdrawals can raise overall lifetime tax exposure compared to smoothing income earlier. The risk isn't panic. The risk is sequencing. So what can be done before the math hardens? First, model provisional income, not just your tax bracket. Look at how withdrawals interact with Social Security inclusion thresholds. Second, consider smoothing taxable income before required minimum distribution age. Strategic Roth conversions in lower income years may reduce future forced withdrawals and reduce how much Social Security is included in taxable income later. Research from firms like J.P. Morgan Asset Management and Schwab consistently highlights income smoothing as a way to manage lifetime tax drag. Third, monitor Medicare IRMA thresholds annually. Even modest income increases can trigger premium adjustments. None of this eliminates taxes. It reduces layering, and layering is where quiet erosion happens. According to the Congressional Budget Office, Social Security spending continues to rise as demographics shift. Policy evolves, but the structural math of provisional income and required withdrawals is already here. Most retirees don't lose ground because of a crash. They lose ground because multiple reasonable decisions stack on top of each other. Deferred taxes, forced withdrawals, fixed thresholds. Individually manageable, collectively expensive. If you understand the structure early, you have leverage and no reason to panic. If you wait until required distributions begin, most of the flexibility is gone. Stay informed. If you found this helpful, you'll like this channel. Hit the like button and subscribe for more videos like this. You've got this. Thanks for watching.